I may regret saying this, but my hot take is I do think it's important for companies to fail quickly.
Hey everyone, welcome back to the Data Minute Podcast. I'm your host, Peter Walker, Head of Insights at Carta. Today, I was thrilled to be joined by Brianne Kimmel, Worklife Ventures Managing Partner and Founder. We touched on, so many different subjects. For founders, we touched on things like the reliability of AI revenue, what it means to be an AI-first company in this new wave of SaaS and software. We touched on go-to-market for technical founders and why people like Worklife can really be a huge trajectory boost for technical early-stage founders. We also talked about the advantages of being in the Bay Area and the kinds of companies that should maybe consider moving. And then for VCs, we talked about a host of subjects, including life as a solo GP, why it's valuable to be a solo practitioner when it comes to VCs. We also talked about strategic DPI, this big industry conversation that's happening right now about when it makes sense for early stage funds to exit those investments pre-IPO. Brianne is an absolute wealth of knowledge. Let's jump into the conversation right now. Brianne, I really appreciate you being here.
Thanks so much for having me. Longtime fan.
Oh, thank you. It sounds like you are familiar with our studio from the clips that you've seen, but you didn't see the behind the scenes. How does it look in person?
It's fun to see how everything happens here.
Okay. Well, I appreciate that kindness. Maybe give us a quick intro just to kick things off on Worklife and the kinds of companies that you've been investing into.
Yeah, absolutely. So Worklife was founded in 2019. We are formation stage investors, typically backing one or two technical people who have a big idea, and we help with go-to-market. Early investors in Deal, High Touch, Metronome, Hex, a lot of developer tools, data infrastructure, things of that nature. Prior to starting the firm, I was on the go-to-market team at Zendesk, focused on self-serve growth for a while, then our move-up market. So I really like helping early stage companies get the product in a good place for product-led growth. And then in parallel, we work together on building out the sales and success and all the various different go-to-market functions.
Are you finding that technical founders are better than they used to be at go-to-market, or like more aware of the challenges? Or is it really you're teaching just as much as you ever have?
Historically, I would say yes. I think 2 years ago, from a go-to-market perspective, you talk to a lot of founders that have, we've invested in teams that have left Segment or Airbnb or many of the last generation great companies. That's typically been our model, is we write the first check when people are leaving. And so they've had some go-to-market awareness.
Yep.
They've either sat in on meetings or, they've caught up with a few colleagues before they left to start something new. And so there was that maturity. I do think now in the context of AI-first companies, a lot of the playbooks are being completely revised and rewritten. I think a lot of the old advice and even just the sound bites that you read on Twitter may have been true for the last generation of SaaS companies, but I'm finding the AI-first companies are very different.
Interesting. That was one of the biggest things that everyone should read your blog, by the way, on Worklife. But one of the points that has come up again and again is about this AI-first revenue wave and the trust or lack thereof that some investors have in it. So when you're talking to early stage AI native founders, how do you talk to them about their traction metrics, or like how reliable is some of this revenue that seems to be sort of growing exponentially for some of these companies?
Yeah, it's a great question. I think there's a lot of false senses of security in the market right now where you may be able to close a much bigger customer than you expected. You may see, an expansion rate where a lot of seats are being added and a lot of people are using this product inside of a big company. But I do think in a lot of ways, we're all waiting for renewal season to happen. And I think renewals are the new revenue.
Yeah.
The reason being there's a lot of companies that have an AI mandate. And so their leadership team is encouraging them to try a lot of new products. In many cases, the ACV is low. And so they're doing a lot of trials. With an intent of then choosing their primary partner.
Right.
So I do think for a lot of companies, they're trying to figure out how do we make this product sticky? How do we make sure that we're spending time with the leadership team and having very strategic conversations with them? Because competition is fierce right now.
Yeah.
And I know that a lot of more mature tech companies are trying a lot of products to see what they want to use long term.
Do you think that is solved this year in 2025? Like we'll have a much better idea of it? Or is it something that kind of, given the rate of company creation, is always going to be a question?
I think we will, to an extent. I think going back to your point around founders being more maybe go-to-market aware, I'm seeing some really interesting early stage companies that are already thinking about channel partnerships. I think more strategic founders aren't afraid of raising strategic capital from mature tech companies and folks in the ecosystem that can really give them a distribution advantage. So I do think that in many ways, historically startups were viewed as an experiment, and you had a specific amount of time to figure out if this could become a very enduring company.
Right.
I think the pressure's on now where startups are raising a lot more capital up front. The expectation is they're building a mature company much sooner than expected, and they're doing that through a lot of relationships right here in San Francisco.
And does that, you hit the nail on the head here with companies raising rounds either much larger than before or kind of avoiding capital raising altogether. How do you coach founders through that moment? Because it seems as though I get different answers no matter who I'm talking to.
Yeah, it's a good question. I think that Worklife attracts a very specific type of founder. I will be honest from that perspective. Whether it's Deal or High Touch or Metronome or any of the companies that we've partnered with, we do view ability to raise capital as a superpower. I think when there's a lot of competition in the ecosystem, the founding team that's credible, that has a reason for raising a lot of money, that has sort of the pedigreed firms on the cap table.
Yeah.
I think it does make a huge difference in terms of the long-term trajectory of the company. And some of them are non-obvious. From an enterprise perspective, big companies don't want to work with startups that may go out of business.
Yeah.
There's internal team costs. There's also running the risk of having to rip and replace and sort of switch out your tooling, which is a headache internally. And so they do look for those companies that are backed by a top tier firm, that have enough capital to stay in business, and that are able to be solid long-term partners.
Yeah.
I also think that from a talent perspective, it's a very competitive time in terms of the hiring landscape.
Yeah.
I think that, smart people continue to join OpenAI and Anthropic and some of the larger scaled AI companies that still have upside. I also think that for repeat operators, they're looking for a company that has upside, that is trusted in the ecosystem. And so I think the branded firms can still sort of bless the next generation of great tech companies. And so I think for us, we aren't afraid of encouraging founders to raise a lot of capital. I think in this point in time, it helps to box out some of the competition, and it just helps them become an enduring company sooner.
Do you think that is mostly due to the, let's call it the credibility stamping of some of the bigger funds, or is it actively that they need to deploy that capital as quickly as they used to?
Yeah, it's a good question. I mean, the companies being built today, it is more expensive to start an AI company. I also think there's a lot of pressure from a competitive standpoint, where the majority of our portfolio companies around Series B start to think about their M&A roadmap. And so they are...
They're themselves buying other companies, not...
Yeah. They're essentially either... buying competitors, they're thinking multi-products sooner than maybe historically would have been possible. When I was at Zendesk, I worked on both core product and then our move up market, which was through upselling and cross-selling new and experimental products. And I think that's something that came much later in the company's history, that came post-IPO. I don't think startups today have that luxury of waiting until post-IPO to become multi-product. I think
Berkeley would have to have IPOs in order for that.
Yes, that's true. That's true as well. But I think looking at, Deal is a great example. A lot of their recent market share has come through acquisitions. Yep. And so I do think that's going to be a new muscle moving forward, where founders need to understand that as a part of company building and product building.
Do you think that also means that companies will fail faster as well? Like, it'll be more obvious at the early stages whether or not you have the capability to keep growing into multi-product suites, et cetera, so that maybe even founders who would have stuck with it for 5 or 6 years after a seed round, like, shut down and start up again?
Yeah, I mean, my hot take, and I may regret saying this, but my hot take is I do think it's important for companies to fail quickly. I think that we've seen generations of startups where, you continue to operate under the assumption of runway. And I think runway can sometimes be a very bad thing for companies. I think especially for early builders and I think early career folks that join a startup, it is really frustrating to join a company that it's good but not great.
Yeah.
I also think joining a company, like there's opportunity costs. And I think like the best thing you can do in your career is to join a rocket ship and to learn best practices and to work alongside highly ambitious people that will go on to do something even greater than that last company. And so I do worry with some of the companies that, and I think this is, traditionally like more metrics driven SaaS companies can be good, but they're around for many, many years. There's no path to liquidity. Competition may be right around the corner. And I think with the new modern AI first companies, the competition may scale much faster than you could have ever forecasted or imagined. And so I do think we're entering an era where the great companies will continue to acquire and get bigger and stronger and become the new incumbents very quickly. And then I think there's this class of companies that have more traditional linear growth. And I think they're going to get displaced by some of these larger companies that are more ambitious.
Have you had to coach founders through that shutdown or keep going moment? And like, what are those kind of conversations like?
I fortunately haven't coached through that yet. I do think something that came up in, we're investing out of our second fund. I would say the beginning of the fund was maybe more traditional SaaS companies. The second half of the fund is more the hot wave of AI first companies.
How quickly things change,
Yeah, and it's been interesting to see. I think for a lot of those companies, they've been able to figure out their AI strategy fairly quickly. Either expanding with a new AI first product that's something that they can upsell customers, or I think in a lot of ways they've fundamentally hit reset on how they want to build the company internally. It's been interesting to see how quickly startups have been able to adapt to automating their outbound efforts and keeping the SDR team low. Or building out certain functions fairly quickly and mostly on evenings and weekends where they've been able to keep the revenue per head quite high because they're not dependent on building out large traditional maybe growth stage teams.
Yeah. So do you think that lean headcount, I mean, it's one of the biggest trends that we see in our data is just the median number of people working at these startups on the day they fundraise is just lower and lower year by year. And we actually recently just went below 2019 levels. So it's not just, hey, we overhired in 2021.
Yeah.
It's much more, this is a fundamentally new way of thinking about business. And does that come back to the idea of like ARR per employee is something that's bandied about far more than it used to be?
I think so. I mean, I think it's always been important. I think it's definitely a metric that's been measured more so at later stage or public SaaS companies, but I do think it's something that early stage is starting to really think deeply about.
Yeah.
I also think that we're in an interesting place in time where if you're based in the Bay Area, there's so many companies working on agents and automation and sort of this modern way of building a tech company where I am curious to see not only the winners from, more of a, company performance perspective, but I think the winners in terms of who's built the leanest top performing team in the Valley.
Yeah.
And so that is like something that comes up in founder dinners and conversations that I'm having that, a lot of founders are wondering like, how is this team structured? How are they so lean?
Right.
If we need to make a hire, like how do we actually structure that role where we're setting up an IC for long-term success where they may own more and more and more of a function? Like I think a lot of these roles are starting to collapse into one.
Yeah.
We've talked about sort of the designer developers. I also think there's something interesting and sort of how we think about solutions engineering and all of these various different functions within a developers tools company where I do think like that is a type of company that's much leaner than I would have expected.
And do you think that's only happening here in the Bay? Or like what is it about the Bay perhaps that lends itself to those kinds of conversations?
I do think for I've always felt this way for enterprise companies. I think it's important to be here. There have been many ways
At the very beginning, or is it okay to grow elsewhere and move?
Yeah, I think there's exceptions. Atlassian's an exception. Supabase is an exception. I think there's many developer tools where if you have such a strong pull from the market and you're selling to a technical audience that doesn't need or want that amount of face time, I think it can work well. But I do think for the run-of-the-mill traditional B2B company, it's really important to be here. I think the conversations you have with other founders are important, whether that's thinking through strategic partnerships or, reseller programs or integrations. Like I think the majority of companies that we've invested in, they need to think about an apps marketplace and their integration strategy sooner than expected. And so having those close relationships with other founders in your ecosystem is really important.
And do you have an opinion on, physically moving here as opposed to coming here every quarter? Like there's just something else about being located here that really matters?
For formation stage, I think it's important to be here.
Yeah.
For many, many reasons. But I do think that the density of talent is here. I also think that for a first-time founder, the community and ecosystem and just the volume of dinners and discussions and hackathons and things that you can do really set the company up for success.
Sure.
I also think that we're entering a world where, historically the notion was don't talk to VCs unless you're raising. I think that's changed a lot. There's a lot of operators that are now full-time investors. There's a lot of very talented GPs that are leaving and starting their own firms. I think getting to know investors early and really viewing them as collaborators is helpful. And so I think it's really important to be able to do the coffees and the walk and talks and all of these things in the Valley.
For sure. That actually, is a question that came to mind as we were talking before we jumped on mic here, which is like the changing world of VC, GPs, and firms. What do you think is driving all of the sort of name brand people that we've seen leave these bigger funds and set off on their own? You were obviously a bit of a trailblazer in that regard.
I'm laughing because, when I was first getting started, I remember Nikhil at Footwork wrote a really great post around solo GPs and sort of the rise of the solo capitalist. And, at the time it was really interesting because for many of us, we were previously operators. I was at Zendesk, angel investing on evenings and weekends, hit an inflection point where I wanted to do venture full time. So I ended up raising from founders in my network, both later stage enterprise founders and some public company CEOs as well. And it's been an interesting journey where I think for a lot of the solo GPs, we're able to move very quickly. Without the bureaucracy, without the internal meetings, without, sort of the passing a founder to folks on the operating team. Like you can own the relationship end to end, which is what I really enjoy doing. I say formation stage because sometimes it's a pre-seed, sometimes it's a large seed. I think for us, we write the first check as someone's leaving a great company. We help source and close customers. We get involved in revenue operations. We get involved in, building out the sales team. There's a lot of things that need to happen in the first 6 to 8 months of building a company. And so I enjoy doing those jobs. And so I also think for me, it's the solo GPs are sort of optimizing based on your skill set and how you can win deals. And so I think we'll continue to keep work-life fairly lean. I think a lot of the last generation of venture, which was have a really massive operating team. I think some of those sentiments have changed over the years from a founder perspective, where founders want one person to call and they want that accountability. And so I think that one-to-one relationship is really important. And that's the part of venture that I don't think should scale.
Do you think, that was the scale question comes up immediately there, which is like, okay, that's a beautiful model, but it has a natural cap, right? There's an asymptote to how many companies you can support and feel really good about the level of support that you're giving them.
Yeah. And I know Charles Hudson has talked about this a lot.
Yeah.
The fund size is the strategy and the number of companies is the strategy as well. And so I think each GP has their own sort of bandwidth of the number of companies they'd like to take on and work with at any given time.
Do you agree with Charles's? I think he and I were talking about this when he was on the pod about how he thinks that it's an easier pitch to LPs if you're keeping that fund size for Fund 2 and Fund 3 and Fund 4 the same. Do you kind of agree with him there? Or do you think you can scale the AUM in reasonable ways?
Yeah, it's a good question. I mean, every LP has a different strategy as well.
Yep.
I've talked to LPs that love high velocity funds. And as an operator, I don't love high velocity funds.
Can you define that?
Sure. If I were we typically invest in, somewhere between 25 to 35 companies. So we kind of run it in batches. So at any given time, I'm working very intensively with 3 or 4 companies at a time. which is great. I can go to their team offsites. I can source and close engineers. I can make warm introductions to customers. I can be very deep and very involved in the business. But essentially, I'm running it like a sprint. So we do that for the first 6 to 8 months of the business, get them to a good place from a revenue perspective, make the warm intros, help them raise the Series A, and then continue to be helpful. But it's more in sort of a coach or advisor capacity. When I think about some of the higher velocity funds or, in talking to peers who I have a ton of respect for that say we write the check and then we, take a step back or we let smart people do the job. I think it's very different in the types of companies that I invest in where every warm introduction matters. How you draft an email matters. Knowing which customers are potentially at risk of churning matters a lot. And so I would say for many portfolio companies, and these are companies like as large as Deal, knowing exactly what's going on in the business and being able to help behind the scenes is critical.
Yeah.
And that doesn't change over time. And so I think a lot of these relationships are, in fact, 10-year relationships. We just happen to invest at the formation stage. And I think with some of the higher velocity funds and, LPs that are looking for you to invest in, 50 plus companies, it's just harder to have a reputation of being helpful if you're moving with that speed and velocity.
Yeah. Are more LPs looking for a broader set of initial portfolio bets? Is 50 the new standard for
I
a
don't
seed
think
fund?
so.
That seems
No,
like very high.
I think there's some fund of funds that like higher velocity funds. I think for a lot of the institutions, like as we're institutionalizing firm, a lot of the endowments and some of the more, I would say more patient LPs
Patient is a lovely word.
Are less inclined for that. I think they want to think about, see how you can build ownership. They want to see what is your ability to stay relevant inside of companies that matter. And I think that's a huge thing. Like I've worked with founders many times on sort of cap table consolidation, where, as a big firm's coming in at the growth stage or as, there's movement in the secondary markets, sometimes it does make sense to either buy out early investors or consolidate the cap table because, those formation stage investors haven't continued to be helpful or they're less involved in the business. I think for us, we have capital partners across the stack. And so we want to continue to be helpful. We want to continue to do our pro rata. I think in the context of AI, sometimes the pro rata is far greater than the size of our current fund. And so we have partners that we work with later stage as well. But I also think for us, something that we think a lot about is how do we deliver DPI to our LPs? That came out of just a deep appreciation for the fact that Fund One was primarily other founders and CEOs in the ecosystem who have been incredibly helpful. I know they had felt the liquidity crunch that a lot of LPs were feeling, but these are individuals. And so if it's buying a house or sending your kids to college, we want to be very mindful of that. And so we do take chips off the table when we can, usually when a company hits about 50x. Not selling the full position, I still want to be involved. But it has been helpful to kind of find ways where either we can work the secondary markets to our advantage, or we have great LPs and capital partners later on that would love exposure to some of the companies in the portfolio.
That's it's good to think of, sometimes we have nameless, faceless LPs who are big institutions, and it kind of feels like, what does liquidity really mean to these people? But a lot of founders and other operators in the ecosystem are LPs in the venture funds. And the liquidity crunch has been really real for a lot of those people in a very serious way.
Yeah, absolutely. And I think for Worklife specifically, I want to have long-term relationships with my LPs. I go to dinner with them. I know their families. I know their kids. Life happens as well. And I think a lot of people forget that life is happening while we're building our companies, or in my case, while building the firm. And so I think for us, we do want to be very LP friendly from that perspective where we want to do what's right for founders. We also want to keep in mind that we need to do what's right for our LPs as well. And so, we have made decisions to generate some DPI, which has been both helpful for founders and also incredibly helpful for our LPs.
I can imagine. The DPI question, are you, there's been a lot of talk about manufacturing DPI, which I often feel has this negative connotation of forcing sales or like pushing a merger or an acquisition through that probably wasn't the right move for the long-term, et cetera, of the company. But it sounds like the secondary markets are actually much more of the the bigger piece of that manufactured DPI pie. How do you view secondaries as an early stage fund?
Yeah, and I want to go back to the previous point as well. It's interesting. I don't believe that companies are ever sold, they're bought.
Mm-hmm.
And so I think to manufacture something would be incredibly difficult.
Yes.
I think as the markets have become more efficient and as you have not only a lot of capital in the ecosystem, you also have a lot of repeat founders and just sophisticated people. And so I do think that, there aren't really any deals in venture. Like I think that the companies that have been expensive from the beginning have been great companies. And so I think in a lot of ways, the way that we think about acquisitions is those are things that, typically come later in the company's life cycle. Like we haven't really had short-term liquidity when it comes to acquisitions. Deal's a great example, and other companies that as they have scaled and, acquired companies, built new products, like these are very stable and enduring platforms. And so we haven't really seen those fast acqui-hires or any sort of positions like that have maybe generated short-term liquidity.
Yeah.
And so I do think a lot about the secondary markets, where if we are looking to generate DPI, if we are looking to truly be helpful to founders in that next phase of growth, we sometimes need to create room for the later stage investors to get the allocations that they want, or being more generous and thinking about doing nice things for LPs. Like there are ways that we like to invite our LPs to either co-invest alongside of us or potentially buy some of our shares if they're looking for that direct exposure as well.
Interesting. Have those conversations with the LPs, I'm assuming there's a ton of overlap between the LPs in Fund 1 and the LPs in Fund 2, but have the conversations around DPI or liquidity timelines changed as you were going into Fund 2? Given that, Fund 1 wasn't that long ago, it's probably not the case that your best stuff is you're going to keep for a long time.
Yeah, exactly. Yeah, I think that, I think companies that are doing incredibly well, there's just a lot of demand to invest in those companies.
Yeah.
And so I know we're all on the email lists from various different secondary transaction
some shadier
platforms.
emails
So
than others.
we know the list of companies that LPs and that family offices want exposure to. I do think that for us, we've typically worked alongside the growth stage firm coming in or alongside the founder where we're doing things in lockstep. I don't believe in selling early and selling to like any of these like secondary sharks that exist.
Yeah.
I also encourage friends that have equity either from their last startup or their current startup to sort of entertain those ideas as well. But I think it is fair. I mean, companies are staying private longer. I think employee tenders are really important. I think thinking about liquidity for early investors is important as well. And so I just think the market has changed and that it's more efficient and there's a lot of different ways of thinking about liquidity. And so that is something that's come up more in recent years than it had previously.
So what do you think is going to happen with IPOs? Are we getting a bunch of IPOs this year?
I hope so.
Yeah, hold on, knock on wood. I don't know where we're going.
I hope so. I think, having worked closely with folks that had worked on, the Zendesk IPO and some other companies in the category, I am excited to see companies go public. I guess I'm a bit more traditional from the perspective that I like when startups have traditional boards. I like board governance.
Yep.
I think that having really smart investors and really smart, previous operators or previous founders on your board can change the company entirely. And I've seen that time and time again with our own portfolio companies. I also think that going public is a really special moment for a lot of people.
100%.
For the founder, for the early employees, for the early investors. I think it's time to bring back that magic where ringing the bell means a lot to a lot of people. And I think moving forward, it's also a great way for founders to really scale into that public company CEO position, which is a new phase of growth and something that's really exciting to see. A founder that maybe you backed at the seed stage when it was just one or two people an idea, to see that career arc is really important and something that I'm looking forward to.
Well said. You're here. Wait, you actually mentioned something fascinating about how do you talk to founders about board composition beyond the investors? So obviously, typically founders and then the lead from every round, et cetera. But when you're bringing on independents, like how do you think about the right kind of people that should be joining those boards?
Yeah, good question. In terms of board composition, well, I'm happy to see. I think we've shifted away from the boardless company. We had many years.
That seems like a negotiation point.
Companies that were raising unicorn rounds, taking on a lot of capital, no board governance. I think of the companies that I'm most worried about in the context of sort of that tail end of SaaS to now the new AI first wave of companies. I think there's a lot of companies that raised a lot of money that did not have a lot of guidance. I think they're playing catch up and sort of they fall into this class of companies where they have a lot of runway but no direction. And I think that directionlessness is really challenging, especially for employees that joined and had opportunity costs.
You can kind of feel it in the company, it's like, even if it's not spoken about necessarily to all the employees, I think it is something that kind of, when I talk to friends who've been at places where there doesn't seem to be one North Star, like everyone kind of knows.
Yeah, I agree. And I do think, having been on boards, having, seen the change in the metrics when a really good board member, steps in at a Series B or a Series C, it really energizes the company. It also gives, all of the employees a sense of confidence. And so I do think that's incredibly important to continue to have a board. When it comes to independent board members, the list is actually much smaller than you would think.
Ooh.
It depends on the category of company. It depends on the buyer. I think founders typically have one or two like dream people that they want to join the board. And so part of my job is really making sure that I have, I'm maintaining those long-term relationships with really solid independent board members, and knowing their bandwidth and sort of gauging what is the likelihood of them joining the board of this company. And if, they're fully tapped out right now, how do I stay on their radar and make sure that, I find a way to work with them in the future?
How many boards is too many boards for one individual?
I mean, it's a good question. It depends. I mean, everyone has different bandwidth.
Yeah.
I've been really impressed to see. I mean, some people can do this in their sleep. I think there's a handful of very good, traditional Series A and B investors who can diagnose a problem quickly, who have the network behind the scenes to make things happen. I think a lot of the, call them Silicon Valley celebrities, they've earned that right.
Yeah.
Because time and time again, they've changed the entire sort of structure of a company, and they've had meaningful impact in a short amount of time.
Right. Yeah. It's not just big names on X, right?
Exactly.
Like they actually had something to back that up. Totally. Maybe a couple of slightly more, advice-driven questions here for maybe people who are thinking about becoming VCs as you have. What did you get from angel investing, and why should someone angel invest even if they feel as though, look, money's actually kind of tight? Like, is this a right use of my cash right now?
Yeah. It's interesting. I think for me, and I think for a lot of early career operators, angel investing was a way to build a network.
Yeah.
I found that I really enjoyed the work I was doing at Zendesk. I really enjoyed meeting my peers at Dropbox and Slack and Segment and all these other companies that were, operating sort of in the epicenter of Silicon Valley, which at the time was mid-market. So we were all in the Tenderloin, and we were all hanging out, grabbing coffees and stuff like that.
A different time.
And so I think it was helpful where, I think especially if you're in a product position, I think especially if you're, leading a go-to-market function, startups are going to reach out and they want your advice. And so I think it's only natural to want to angel invest and be involved in that company. I also think, I've written a lot about this. I encourage founders to think about this. A small check from a great operator goes very far. Whether it's quickly diagnosing a problem through the investor update, whether that's, a monthly coffee and just sort of picking their brain on, what you should think about next. I think they're very helpful in knowing what's around the corner.
Yeah.
I also think from a hiring perspective, it's been great as well. Like there's been time and time again where someone's angel invested in the company. They sort of view that as a way of getting close and learning a lot about a handful of companies. And then, when they hit 3 or 4 years at their startup, they're more inclined to join that company where they've already been a part of the team.
The pre-wiring team members. Yes.
So I think that's something that's worked well over the years as well. I also think as an operator, everything you're learning can be passed to the next generation of great companies. Like I always like to think about shared secrets and sort of things that you've learned, at a Figma or a Notion. It's not obvious to an early stage company.
Right.
I think when you're just getting started, your job is to really get an MVP out. I think there's a lot of just deep emphasis on product. But then there's a lot of just very quick, helpful insights that are not obvious when you're heads down building an early stage startup. And that's where I think operator angels can add a lot of value.
Do you have an example of a shared secret for maybe more technical folks that are kind of unaware of how to do go-to-market?
Yeah, good question. I mean, I think the term that gets thrown out the most is PLG.
Yeah.
And I think...
are we pro or anti that term?
I like it.
Okay.
No, I like it. I can't hate. I mean, that's been most of my career, so I can't hate on something that's been most of my career. But I feel like with something as simple as PLG, you could read all the blog posts. You can sort of have the high-level, good-sounding advice that you can get online from anywhere. But I think the real thing that an operator angel or someone can bring to the cap table is really identifying where are you at today and what are the missing pieces? What's the low-hanging fruit from a product perspective? Who's currently missing from the team? Like, how do you really start to build something that scales? As opposed to, I think a lot of times there's really good sounding advice online, but it might be for the wrong sector or the wrong stage, or you don't currently have the right team dynamic in place. And so you're not going to be able to do it well.
Yeah.
And so I think having that real-time advice is super helpful.
Yeah, well said. I think that there's a big difference between reading about something and actually understanding what it looks like in practice. And so it's a great use for operator angels. Maybe we come to the end here. When I read your work either on X or I'm reading all the blogs that you've written, et cetera, you clearly have this focus on breadth. Like you're talking about so many seemingly distinct subjects that then have these points of overlap. Why is it important to be that curious about so many things?
It's interesting. I think everything falls under this sort of broader umbrella of what is work life. And when I spent many, many months thinking about the vision for the firm. How would we be different? Do I want to call it something or do I want my name on the door? Like there were so many existential questions I had to ask in sort of making this transition from operator to full-time VC. When I thought about work life and what I wanted the firm to stand for, you start unpacking all of these areas of interest and all of these things that are actually quite important if you want to change how people work. I spent a lot of time thinking about education, which is the precursor to work. So what is my opinion on traditional college? What is my opinion on coding boot camps? What is my opinion on vibe coding? Like, can you purely learn how to code online with no technical background? And could you, start a company or join a company? So I think there's all of these questions that tie into this broader vision of if we truly want to change how people work and if we want to make that better, we're going to get pulled in a lot of topics of conversation. I think right now something I've been thinking a lot about is just the overall cost of goods and the impact on tariffs. First check in Settle, first check in Pietra. We've done a lot of commerce infrastructure and tooling. And so we need to understand exactly how expensive are these goods going to become. And what does that mean for CPG founders who, maybe this started as more of a passion project, but they just made the switch full time? Or, what does that mean for the average American where, there's a lot of folks that were impacted by a lot of the tech layoffs. There's a lot of folks that were remote, but then companies went back in office and now they're trying to figure out what they want to do next. And it's harder to find a fully remote job. And so there's a lot of questions that we really think deeply about and want to have a strong opinion. And so I do think the breadth comes from really caring about how we can have impact on the work lives of other people. But at times, yes, I could be exploring many different topics and sort of how that ties into that broader vision.
I love that. And so much of it is driven out of the curiosity born from these companies that you're seeing and investing into and thinking through with them structurally what would have to be true about the economy, about the world, et cetera, as they kind of grow.
Yeah, and I think all of it goes hand in hand. Like I mean, I'm wearing a Whoop. I care a lot about health and longevity, and people, being top performing, as individuals, because that does tie into your performance at work. And I think there's a lot of interesting topics that are happening. Like, what does it mean that people are drinking alcohol less? Like, how does that impact your work life? I think it does to an extent. I think in many ways, shapes and forms. We've seen this where the next generation isn't drinking as much. What does that mean for hosting a company happy hour? Are people actually going to come, or is this not a good use of company spend?
Yep.
I think when it comes to how people network, like I was laughing hysterically when I read that, sauna culture is the new form of networking. Like, I think that's so interesting, where, back in the day you used to go out for a beer, but if people aren't drinking as much,
now you go
doing
sweat.
Yeah, doing a little sweat is a great way to network. And so I just think the world is changing very quickly. And as an investor, I want to be up to speed on anything that has a potential to change how people work.
I love that. We like to wrap these things up with a question. Is there an example of, either for yourself or for any of the GPs that you know, something that you just found unique and novel that a VC has done for a founder? So something that is not just, hey, here's capital and we'll see you again in 10 years, but like some interesting idea that really shows how supportive that a lot of these GPs can be.
Yeah, interesting. I mean, as far as specific examples,
you don't have to name names if you don't want to.
Sure. Yeah, I'm trying to think. There was definitely a wave of VCs doing a lot of gifting and a lot of trips, and I think there was like this older generation of venture, which I think has plenty of tales to tell, and it's all very interesting and part of the Silicon Valley lore. I would say, it's interesting to see. I'm very much on the side of GPs starting their own firms. I love what Sarah Guo is doing at Conviction. I love what Christina Shen's doing at Chemistry. The GPs that worked like founders at the big firms, when they leave and start their own, I'm just seeing a next level of work ethic and of founder friendliness and of really empathizing with the fact that for the first few years of building a company, you do not have work-life balance. Like, I am so mindful of that, where a lot of the founders that we've invested in, they're not taking a vacation. They may attempt to take a vacation, but they were on their phone the whole time. Right. Or, I think for a lot of folks, like, whenever possible, we like inviting, partners and family members to the stuff that we're doing. Like, if we're hosting a dinner, we would love for you to bring your partner, because I think it's really important to keep in mind that there are so many people making sacrifices to get a startup off the ground. And many of those people are family members that you haven't had the opportunity to meet yet. And so that's something that we really care a lot about at Worklife. But it's been interesting to see the fact that I think a lot of the traditional, stereotypes of VCs are changing, where I think a lot of the best VCs work like founders. And I think a lot of us are a lot more mindful of the fact that, especially at early stage, we can't take August off, or we can't do a lot of the traditional things because the companies that we're working with are on a race against time, and they need to get to product market fit, and they need to do a lot of things incredibly well. And so I think the hardest working VCs are the ones that are going to continue to start their own firms and to continue to do well.
Yeah. Here's to a wave of solo GPs. We love it.
Yeah, we love it.
That's amazing. Well, this has been an incredible conversation. Thanks so much for coming in.
Thanks for having me. This was great.
Super fun. Welcome back from San Francisco.
Thank you.